The current market environment for Opendoor Technologies is nothing short of a high-wire act. And if you are looking at your screen right now on this Friday, April 17th, 2026, you are seeing that tension play out in real time. As of 1 p.m. EST, Opendoor stock is trading at $5.27, marking a significant intraday climb of 9.34% from its previous close. While the broader market is grappling with a mix of macroeconomic signals, Opendoor is carving out its own path today, fueled by a heavy dose of institutional repositioning and a narrative shift that most retail traders haven't fully priced in yet. You might expect a company that lives and breathes on mortgage rates to be a sinking ship in a higher-for-longer world, but the reality is starting to break away from that common assumption. While the general belief is that Opendoor is just a victim of the housing market stagnation, the deeper truth is that the company is currently undergoing an aggressive operational overhaul that they're calling Opendoor 2.0. We are seeing weekly home acquisition volumes reportedly surge by nearly 500% under the current leadership. This isn't just a small bounce, it's a fundamental change in how they are attacking inventory. Most people are still looking at the old Opendoor that got burned by the 2022 rate spikes, but the current volume suggests a much more agile player is emerging. The volume we are seeing today is particularly telling. With over 59 million shares trading hands against an average of about 27 million, the conviction behind this move is massive. Institutional activity is the silent engine here. Morgan Stanley recently disclosed a massive 10.2% stake in the company, holding nearly 98 million shares. When a powerhouse like that decides to own a double-digit percentage of a mid-cap tech real estate hybrid, they aren't looking for a quick flip. They are betting on a structural recovery. This institutional backing acts as a floor, contrasting sharply with the bearish sentiment still held by many sell-side analysts who have price targets much lower than where the stock is currently trading. If you look at the daily swings, Opendoor is behaving like a coiled spring. We saw it tumble earlier this month on weak GDP revisions and sticky inflation data, but the recovery since then has been relentless. The market is beginning to reward the company for its leaner infrastructure. They've managed to slash annual hosting and technology costs from $12 million to less than $5 million. In the world of high-growth tech, that kind of discipline is rare. It's no longer just about buying every house in sight, but it's about the cash now, more later incentive model that is actually drawing in sellers who were previously hesitant to move in a high-rate environment. The expectation was that Opendoor would struggle to find inventory as homeowners stayed locked into their 3% mortgages. The reality is that life-changing events, jobs, marriages, downsizings, are finally forcing those homeowners to move regardless of the rate, and Opendoor's new 4.99% mortgage product is acting as the bridge that makes those transitions possible. By offering a rate below the national average through their own financing arms, they are effectively manufacturing their own demand. This is a massive strategic pivot that moves them away from being a simple house flipper to becoming a full-service real estate ecosystem. Let's talk about the business model for a second, because that's where the long-term risk lives. Opendoor operates in the iBuying space, which means they use algorithms to price homes, buy them directly from sellers, and then resell them on the open market. It's capital-intensive and incredibly sensitive to the speed of the market. During the housing boom, it looked genius. When the market stalled, it looked like a disaster. Today, they are trying to find the middle ground by integrating title and escrow technology through their recent acquisition of Doma. This allows them to capture more fees per transaction, which is critical when the total number of transactions in the country is lower than historical norms. Earlier reports showed a revenue decline that scared off a lot of paper hands investors, but the Q1 2026 projections are now nearing the $1 billion mark. That is a massive psychological level for a company that many had written off as a meme stock just a year ago. We are seeing a 30% projected increase in home sales volume. If they can hit those numbers while keeping their renovated inventory lean, the path to net income break-even by the end of this year becomes a legitimate possibility rather than just a management pipe dream. There is also a massive short interest element to watch. As of the last report, over 123 million shares were sold short, representing about 13% of the public float. When you see a 9% move on a Friday like today, a good portion of that is likely shorts being forced to cover as the Opendoor 2.0 narrative gains traction. It creates a feedback loop where the higher the price goes, the more the bears have to buy back their positions, further fueling the rally. This is why the stock is outperforming its peers in the real estate services sector today. If you look at the broader landscape, the competition is also shifting. While companies like Zillow have largely moved away from the heavy lifting of buying homes directly, Opendoor has doubled down on being the primary liquidity provider in the market. They are betting that the future of real estate isn't just searching for homes on an app, but the actual transaction being as seamless as trading a stock on the Robinhood app or managed through a Fidelity brokerage account. The goal is to remove the months of uncertainty that comes with a traditional sale. When we look at the macroeconomic pressures, they haven't disappeared. Mortgage rates are still the elephant in the room. However, the market is starting to price in a stabilization rather than a drop. As long as rates aren't actively climbing, Opendoor can price its risk accordingly. The volatility we saw in 2025 was a result of the uncertainty. The 2026 trend seems to be a result of the company finally figuring out how to operate in a high-rate world. They aren't waiting for the Fed to save them anymore. They are saving themselves through cost-cutting and targeted mortgage incentives. For those of you involved in online investing or looking at self-investing through platforms like SoFi
Invest or Interactive Brokers, Opendoor represents one of the purest plays on a housing recovery. It's a high beta stock, meaning it's going to move much faster than the S&P 500 in both directions. If you're using an intelligent portfolio or seeking investment help from a robo-advisor, you likely won't see much exposure to a stock this volatile, but for the individual brokerage user, this is the front line of the real estate tech war. The future outlook for Opendoor hinges on one thing: can they maintain this 500% surge in acquisition volume without sacrificing their margins? In the past, whenever they scaled up too fast, they ended up overpaying for houses and taking massive losses when those houses didn't sell quickly. The reality we are seeing in the 2026 data suggests their pricing algorithms are much more conservative now. They are buying at a deeper discount, which gives them a cushion if the market takes another dip. This is the reality that is currently exceeding the expectations of the bears who expected another quarter of massive losses. There's also the political angle to consider. New housing initiatives and potential mortgage bond plans are starting to circulate in Washington, aimed at increasing supply and making it easier for first-time buyers to enter the market. Anything that increases the velocity of the housing market, meaning how many times a house changes hands, is a direct win for Opendoor. They don't necessarily need home prices to skyrocket, they just need people to move. If people start moving again, the volume of the Opendoor platform scales, and the fixed costs of their tech stack get spread across more transactions. In summary, what we are seeing today is a classic case of the market catching up to a fundamental shift in business strategy. The expectation was that Opendoor would remain a stagnant, cash-burning entity until interest rates dropped to 3% again. The reality is that through the acquisition of Doma, the launch of a competitive mortgage product, and a massive reduction in operational overhead, they have found a way to grow even in a tough environment. The 9% jump today is a recognition of that resilience. The institutional backing from Morgan Stanley and the massive surge in trading volume suggest that the professional side of the street is finally starting to believe in the turnaround. While the risks of a capital-intensive model remain, especially if we see another spike in inflation, the current momentum is firmly with the bulls. We've seen the stock range between 51 cents and over $10 in the last year, and at 5.27, it's sitting right in the middle of that volatility, looking for its next major catalyst. Keep a close eye on the upcoming Q1 earnings report. If the revenue indeed crosses that $1 billion threshold and they show a narrowing path to profitability, the meme stock label will finally be buried for good. This is no longer a speculative bet on a future that might not happen. It is an active play on a company that is fundamentally changing how it operates to survive and thrive in the current economy. The contrast between the old, reckless Opendoor and this new, disciplined version is the primary reason why the stock is showing such strength today. Whether you are using a Fidelity trading platform or the Robinhood app to track these moves, the story of Opendoor in 2026 is one of the most compelling turnarounds in the tech sector. Expect the volatility to continue, but understand that the floor has shifted significantly higher than it was just 6 months ago. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.